Good morning, everyone. Welcome to an episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is No Deal, Better Than Bad Deal. Last week, markets grappled with sizing the aftermath of the Supreme Court ruling that the tariffs under the IEEPA were illegal, as well as ongoing scares around the potential disruption from AI developments. With Section 122 tariffs being enacted at a 10% baseline, with potential to rise to 15%, relief from overturned reciprocal tariffs were short-lived. Similarly, countries who struck trade deals earlier appeared to be getting the short end of the stick. The EU has also paused on the ratification of their trade deal with the US. On this note, while it has been pointed out that exemptions from IEEPA has been carried over to the Section 122 tariffs, the diminished relative tariff differentials between countries accentuated the cost of the trade deals that were being struck. In EM major FX last week, the relative optimism from lower tariffs appeared to have seeped through, as most countries enjoy lower tariff rates even without a deal. That said, the Bank of Thailand still went ahead with a surprise rate cut. A strong Thai baht tightening financial conditions for exporters, that burden of households and SMEs, and incurring inflation expectations amid downside risks were key factors behind the earlier than expected rate cut by the BOT. In Korea, the Bank of Korea stood pat in a unanimous decision. Even as the new dot plot reveals base case expectations of keeping rates on hold, there remains a 20% probability of a rate cut in the next 6 months. For the upcoming week, Australia Q4 GDP is likely to remain robust amid firm domestic demand driven by investment spending growth from data center developments, as well as an ongoing consumption recovery domestically. This will likely assist in the Aussie dollar's consolidation of gains after the upside CPI print last week. In Malaysia, the Bank Negara Malaysia is expected to keep rates unchanged as growth in Malaysia remains very robust and inflation remains very manageable, especially with the ringgit appreciation dampening imported price pressures. All in, US ISM Services and NFP print are the data points to watch this week. But trade policy uncertainty warns against the relief from 10% lower baseline, especially as the energy complex remains in flux from heightened geopolitical conflict that has escalated over the weekend. The inability of US and Iran to strike a deal has led Israel and US to launch strikes on Iran over the weekend that has killed Iran's supreme leader. Subsequently, retaliation by Iran has also resulted in disruptions across the Middle East. In terms of economic activity, with Iran retaliating across the Middle East, airspace is now practically closed as major airlines such as the Emirates, Qatar have suspended their flights from their hubs, and resumption of air travel in the Middle East early this week is very much still in doubt. The uncertainty was certainly in abundance in the energy space. Even as Iran's foreign minister said on Sunday that there is no intention to close the Strait of Hormuz, there was reported messages by Iran's Revolutionary Guards to ships that they are not allowed to pass. Brent crude has kicked off this week, jumping to above $82 per barrel this morning. And as we start this week with the dollar and US Treasuries enjoying haven demand, US Treasuries may need to contemplate the impact of higher energy prices and the fiscal cost of military conflicts. That said, relative to the US, energy costs may become more worrying for Asia's net oil importers such as India, South Korea, and the Philippines. For more information, please refer to our weekly publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.